Good morning, everyone, and welcome to Weekly Profit Talk. As the name would imply, we do this every single week. That day is Wednesday, which is today, and I do this at 8:30 Mountain Time. That is 7:30 if you live in LA, 10:30 if you live in Florida or New York City. So, good morning, everyone, and welcome to Weekly Profit Talk. This week's topic is your medical practice's best business entity structure. There's some question that I get from time to time from people that I speak to, um, both current clients as well as folks that are looking into getting a little bit more help. And that is how exactly to structure their business for their medical practice. If you open up shop and let's say you have one person taking appointments and it's basically you seeing all the patients. Nice, simple little operation. You got one employee and you're paying yourself. You can do something known as a sole proprietorship. Very simple. It is the simplest form of business uh, income reporting. You would file a Schedule C with your Form 1040, and you don't have any additional filings. So you basically just file one tax return. Problem with that is that once your income exceeds a certain level, and I'm going to say my bare minimum is 60,000, but I like to see about 80 to $100,000 in income before you start considering this next step. This next step being uh, considering taxation as an S corporation. Now, this is an election. Okay. An S corporation is not specifically an entity itself. You can't go to your state Secretary of State's website and form an entity known as an S corporation. It is basically a tax election. If you are a limited liability company or a corporation, you can elect to be taxed as an S corporation. And let's first of all go ahead and flash this up here. Um, the election of the S corporation allows you to be taxed as a corporation, but your income flows through to your 1040. So you will have a second tax return to do. It's known as an S corporation return. I can tell you the form number is 1120S, in fact. And this will report the income that you make from your business to the Internal Revenue Service, as well as the state that you live in. If you're one of the 41 states that has an income tax on business income, which is more than 80% of them, obviously. You basically would be reporting the business's income to both of these entities, with a couple of small exceptions. I think South Dakota and New York State. You do not pay tax with this return to anybody, including the IRS. That is a reporting of your income. The S corporation return generates something called a K1, and that reports your S corporation income to your 1040. Okay, so why should you do this? The reason is S corporation requires you to take a reasonable compensation. You see that in that bottom paragraph there. Okay, but the definition of reasonable is open to some fluidity. Let's say that you make $100,000 in a year. Okay, well, typically doctors should be making over $100,000, but it's not reasonable for you to pay yourself more than you make. Am I right? Of course. So what I do in our practice here is we want to nail a number for professional entities at somewhere in the high 40% area, 46 to 50%. Let's say, for example, you make $100,000 this year. Excuse me. If you file a Schedule C, you're going to pay 15.3% tax on top of ordinary income tax and what's known as the self-employment tax. This is to ensure that you're paying both the employer and the employee side of Social Security and Medicare with the income that you're making. But if you elect as an S corporation, you're basically taking a reasonable salary as you go, which is paying FICA taxes, again, Social Security and Medicare. The remainder of the income left over after this is taxed only at ordinary income tax rates. At $100,000, if you take 48K of that in salary, for example, I know this number because I work with them. That's about $7,700 in savings. $7,700 out of 100,000 you make. That's substantial. You can do things with that kind of money. So for a small practice, this is a very good option, and one that you should certainly consider if you're going to be exceeding $80,000 in income in this year. So now, as your business grows, perhaps you hire additional physicians, medical assistants, additional technicians, administrative staff, etc. The business is getting bigger. You're seeing more patients. Your gross revenues exceeding $500,000 to $1 million or more. You may want to actually take a look at being a C corporation, which is just basically also called a corporation. C corporation is an IRS label, basically. Your big companies, your Walmarts, Target, Exxon Mobil, whatever the heck they're called. All of these are C corporations, and they are taxed as separate entities, but the tax rate right now is only 21%. Now, if you're married and you make over, I think it's about $580,000 a year in taxable income, your bracket is 37%. But the corporation tax rate is only at 21%. So now there are some considerations. If you take distributions, unlike an S corporation, if you take distributions from a regular corporation on top of your salary, they are taxed separately, but only at the capital gains rates. So ideally, if you balance your tax situation, one of the main things that you can do with a corporation is basically fiscally plan it so that it has as little of its own net income at the end of the year as possible. You basically expend all your money for selling administrative expenses, staffing, and if there's something that you make and actually sell, perhaps there's a treatment or some sort of widget that you create, that these things all have a cost of their own. And if you reduce your net income for the C corporation as much as possible, you pay significantly less tax for that. And that is a legitimate expense of that corporation. It doesn't touch your personal taxes. So in some certain circumstances where you're affluent enough from your practice, C corporation can be a potential big money saver for taxes. Now, I want to soften that a little bit, throw a monkey wrench into the works, as it were. There was a bit of legislation that was passed a couple of presidential administrations ago. The Tax Cuts and Jobs Act of 2017 was passed right around Christmas of 2017, and it went into effect for tax year 2018. The big thing is that it lowered the corporate tax rate from 35% to 21%. That's why C corporation might, in fact, be a viable option for those of you with that kind of practice affluence. And we're really talking about gross revenues exceeding $1 million. So the thing to keep in mind about this is that the TCJA, as it's known by its initials, has a sunset date of the 31st of December 2025. I'm very aware of the fact that that's only 15 months away. And we want to keep an eye on that because there are one of two things that are going to happen. Either nothing at all. Congress doesn't get it together. They do whatever it is they do up there in Washington, D.C. The whole thing sunsets. We'll return to the 35% corporate tax rate. It is our opinion, however, based on current events, the kind of things I'm seeing in the news, numbers that end in a number divisible by 4 are election years, and there are changes in the wind. We don't believe that it's actually going to increase back up to a full 35%. It's going to be a difficult sell, so to speak. But I'm venturing into the realm of opinion here. Nevertheless, a good tax plan, particularly for C corporations, includes keeping an eye on this. So there are some thoughts for you to possibly make a decision on what kind of business entity you want your private practice to be in. And I hope this is helpful. If you want to talk more about how we provide guidance, business advisory services that goes beyond the mere reporting of financial information, but actually uses a crystal ball and looks into the future of your practice, then reach out to us. We're coming to you live on any one of 3 different social media, and they all have in common that they have a comment section. So if you pop a comment in to any of these, and matter of fact, too, LinkedIn and Facebook also have direct message, and that's ideal. Just hit message and shoot us a note, or you can write to eric@owingsllc.com. Nice, short, and sweet. And reach out, and we can talk about how we make your medical practice more affluent through constant guidance. So with that, let me let you go for now. Have an amazing day and the rest of the week. And if you have a chance, do something randomly kind for a stranger. So until next Wednesday at 8:30 Mountain Time, this is Weekly Profit Talk. And